Hello, Chris Lengquist again to talk to you about the exciting topic of 1031 tax deferred exchanges. And today we're going to answer the question of what is a 1031 exchange? Well, it's simply a rich guy's strategy to help him avoid paying taxes throughout the life of his rental property. Capital gains are paid on the difference between what a house is bought for and what it is sold for. So if a guy goes out and buys a fourplex for $200,000 and then he sells it for $400,000 X number of years later, there is a $200,000 capital gain. Now, I understand for you accountants and bean counters out there that there's a difference. You have depreciation offsets and you have improvements that you can write off. But let's just say, for the sake of the matter, that you bought it at 200, you sold it at 400, so your capital gain is $200,000. Well, with the tax deferred exchange, you can take that $200,000, reinvest it into another property or multiple properties, and never have to pay the capital gain tax. And you can continue to do this on and on and on again until you actually pass away, and then these properties can be willed to your children, and the original basis of these tax 31 exchanges steps up to the current value upon your passing, and that way you can pass along all of these properties that have gained hundreds and hundreds of thousands of dollars to your heirs completely capital gains tax free. So the 1031 exchange is a great tool that a lot of investors like to use. It's not always the tool to use, but in many, many cases, it's a fantastic tool to defer taxes to a future date or to no date at all. So we're going to talk about that today, give you a couple of key terms, a couple of key rules, and then we'll move forward on finding customers that have these 1031 exchanges, because as a real estate agent, it's fantastic when you help them sell one property and then buy multiple more properties. That's good for you, that's good for your business, that's good for your family. Let's delve into this a little deeper. One of the first terms you're going to have to learn as a real estate agent working with 1031 exchanges is what is a QI. And a QI is simply a qualified intermediary. And what their job is to handle the tax deferred exchange for your investor client. The QI is the one that actually will add language to your contract. The QI is the one that actually accepts the proceeds from the sale and then distributes the proceeds to the new purchases, because the investor is never allowed to touch those money. If he does, he creates a taxable event. He's subject to capital gains taxes. So as you learn 1031 exchanges and you assist your investors through this process, you're going to want to become friends with whomever the QI is that they've chosen. The qualified intermediary that I've worked with Starker Exchange, I've worked with Safe Harbor Exchange, I've worked with First American Titles Exchange Company. So there are really good ones out there. Just a word of caution, and it will make you look good to your investor client, I promise you, is make sure that the QI that the investor has chosen is bonded. Because in 2007 and 8 and 9, when the whole real estate economy was collapsing, there were qualified intermediaries that went out of business holding tens or even hundreds of thousands of dollars of other people's money. And that money was just gone, just vanished overnight. So you need to make sure that the QI is bonded for the benefit of your investor. So learn what the qualified intermediary is and does, and you're going to make for a much happier tax deferred exchange. That QI can be your best friend throughout the entire process. So a couple of the rules when it comes to 1031 exchanges that the real estate agent can really help to make sure we don't get in violation of are the 45-day rule and the 180-day rule. The 45-day rule is simply no joke. You want to make sure that the replacement properties that you're identifying are done within the first 45 days. You can't do it on the 46th day. You can't do it on the 49th day. If the 45th day is on a Sunday, you still have to identify by that 45th day. If not, you create a taxable event, and then the person is subject to capital gains, which is what he was trying to avoid before he hired you anyway. So identify the replacement properties within the first 45 days. If at all possible, get them under negotiation and contract and inspections so that you're not going to have a nasty situation where on the 60th day you realize that the properties you identified aren't going to work and you need more properties, but now it's too late, because you don't want to leave your investors holding the bag on that capital gains, or they're never going to use you again. That I can promise you. After you have these things identified, from the original date of closing, you have 180 days to get the identified properties closed. And if you don't get them closed within the 180 days, then you created a taxable event. So you have to identify in 45 days, you have to close in 180 days. It's been my experience since 2002 that getting them closed in the 180 days is no big deal. Getting them identified properly in the first 45 days, that can be a big deal if you don't do it right. Remember, get them identified, get them negotiated, get them inspected, and get all those inspection repairs negotiated within that first 45-day time period if you can, because that still leaves you time to identify other ones if you need to. Now, there's also a rule on how many properties you can identify. I'm going to advise you to talk to your qualified intermediary on this particular deal to see what might be best for your investor. Generally, you can identify 3 properties and then buy any number of those 3. But there are also strategies where you can identify any number of properties, but you have to buy a certain percentage of them and use a certain amount of the assets that are coming out of the property that is just sold. So talk to your QI about that rule. But the rule as an agent that you really need to be careful of is the 45-day rules to identify, the 180-day rule to close. So it's going to be very advisable, if not downright required in a lot of jurisdictions, that for your investor client buying or selling, that there's going to be some sort of verbiage in the contract that this is part of a 1031 tax deferred exchange. Because remember, your investor can't actually be the one that accepts any of these proceeds. So just talk to your QI again. Remember that your QI is going to be your best friend throughout this entire process. Be in good communication with whomever that is. Talk to your QI, get the verbiage that they want added to the contract, whether it's buying or selling, and you're going to be okay as the real estate agent. Again, your job is just to protect your investor throughout the entire process, and the QI and the 1031 exchange is going to be your best friend. So just listen to them. So there you have it, the very basics of what a 1031 tax deferred exchange is. It's not as complicated as people like to make it out to be. Listen, you've got the QI, the qualified intermediary, that you now know is going to have to be your best friend throughout the entire process so that you can be the best advisor possible to your real estate investor. You know, you have 45 days to identify the properties. You have 180 days to close on those properties. You know that the QI can help you with the best strategy as far as how many properties to identify on versus how many that have to be closed. And you know that there's probably going to be extra verbiage that, again, the QI can help you with for your contracts, whether you're buying or selling. So here's the $1 million tip for you as a real estate agent who specializes in working with real estate investors. How many investors out there right now, because they haven't made it a priority, are sitting on properties where they're not getting the full depreciation anymore, or maybe they're not even taking advantage of what the full rents? How many of those investors out there could you go out and do a complete analysis of their property or properties and then tell them what their returns are currently, and then run a hypothetical analysis for them and say, if we sold this one property and turned it into this other property over here, or these multiple properties over here, this is what your overall return would be. And then you would have to decide, is this overall return better than the return they're getting? Is it worth the risk? Is it worth the hassle? Is it worth the money? In many, many cases, the answer is going to be yes. So not only would you be helping that investor with his future retirement and his future income, you'd be helping you and your family with your future retirement and your future income. Listen, folks, this takes work, but I'm telling you, after I've been doing this since 2002. You identify the right properties that your investors are calling you about as far as they're having headaches with them, and you show them how to get a little bit less headaches and to multiply the properties that they have and hire a good property management firm. Listen, you're a central advisor. Show them how to increase their wealth, and by doing that, you'll increase yours. Have fun with this. If you have any more questions about this, or want to get into details about any client that you have, remember, I offer coaching services and would love to help you help yourself. I'm Chris Lengquist. Let's talk soon.